That's the Nifty opening, absolutely flat.
It's holding 17,100, but in the last 1 hour, we've seen the selling pressure accelerate.
There is a bit of selling pressure, can't be wished away. It's not very large in the context of the last 2 days that we've had in the US markets, but it is there. I mean, just under 1% cut on the Nifty. So that's the Nifty 50. Mid caps and small caps came under pressure. And broadly, I mean, in the broader market, it was a very heavy volume-led day on the downside.
Hello and welcome. You're watching us here on Markets Today on CNBC-TV18, the show where we track about 6 hours of trade in 5 headlines. It was a choppy day of trade for most part of the session with a big decline that we saw in the last hour itself. And we ended at the low point of trade. So there was a fair amount of weakness towards the end. And here are all the top stories. Stock markets slide across the world after the Bank of England intervenes in the bond market for the second straight day. Sensex slips over 800 points and all sectoral indices end deep in the red. TCS reports a healthy growth in constant currency and better than expected margin. Management also tells CNBC-TV18 that the order intake run rate should continue well into the next year. The stock ends 1.5% lower. Infosys management intimates exchanges that they will consider buying back shares at its board meet on October 13th. Analysts expect the offer to be at a significant premium to the current market price. Soon after, Jaiprakash Associates says that it will divest its cement assets. India Cements inks the deal to sell its arm with limestone reserves to JSW Cement, but the India Cement stock slips on pricey valuations. Vivi slides on expectations of a sharp decline in exports. Sobha slips on mixed update, while Automotive Axles jumps on Cummins' open offer. Let's tell you what we have lined up for you on the show today. In Market Opinion, we have Vineet Sambre of DSP Investment Managers. Big Corporate Voices, we have Rajesh Gopinathan, the MD and CEO of TCS. They talk about the cautious tone that the clients are singing in. And global cues on the Indian markets are something that we'll be watching out for as the first headline. The top stories that weighs once again on the markets. Markets were range-bound for most part of the trade. And then we saw a big cut in the last hour where all sectoral indices ended in the red. 47 out of the 50 Nifty stocks actually ended lower. Prashant Nair joins in with the details. Prashant, a big sell-off today.
Well, a big sell-off today, and it came a day later. And the reason I'm saying that is because, you know, the big correction in US happened on Friday, last Friday, 4% cut. Yesterday, the market escaped unscathed almost, but it came today. And this has happened before as well, where the reaction to a big cut in the US does not happen the following day, but it does seep through the day later or, another day. And this is, I think, exactly what happened today. The fact that US sold off big time on Friday and did not recover yesterday overnight with another 1% cut. I mean, all of it kind of weighing down pretty sharply. Mid caps and small caps were also down and out actually. Broader markets, a fair bit of pressure. Sectorally, it was all down. I mean, real estate took bulk of the knock. Metals as a sector was down, and IT services. We've been talking about the bounce in the IT space going into the earnings season, and it's played out. The IT index over the last 4-5 days is up some 3%, but today it did give up some of those gains. And I'll come to stocks in a bit. Large cap names which came under pressure: Divi's, IndusInd Bank, Nestle. There was names like JSW Steel, Aisha, UPL, which all lost quite a bit. As I said, broader markets. India Cements was down. Zomato gave back some of those recent gains. Mazgaon Dock, which has been a clear outperformer, gave up gains. McDowell, which is United Spirits, Havells, Tejas Networks, Aurobindo Pharma, but there were many. Actually, it was a pretty big volume-led losing day on the downside, which is never a good thing. The Nifty, by the way, has also broken its 200-day moving average, which stands at 16,986. And, given the big bar that we've had, logically, the next support is about some 200 points lower, the low which was made on the 30th of September at 16,747. I mean, it's basically going back to watching global markets once again. You get these phases where the market outperforms, but eventually some of the damage does seep through like what we had today.
All right, with that, let's get you some market opinion. Vineet Sambre, who's the head of equities at DSP Investment Managers, said that the current consolidation in the Indian market actually is good for long-term investors. In fact, he did say that the correction in the IT space will continue due to global recession fears. So all in all, it's the global worries which are impacting our markets. But over the long term, Vineet believes that this current consolidation / correction that we're seeing should be an opportunity for long-term investors to consistently buy, but importantly buy in an SIP route as against deploying their entire capital in one go.
This type of market which is not a raging one-sided market, is a good market for the long-term investors. You need some consolidation. We've risen for the last 1.5 year, and since the pandemic, and the last 1 year we've been consolidating. So I think that's a good phase. I would say some bit of consolidation weakness because of the global macros allows the long-term investors to work with a more patience, look at good businesses, good companies, and invest with a long-term horizon. So I would say some bit of more consolidation, stroke weakness likely in the Indian markets given the global context, but the long-term view remains intact as far as India is concerned. We've seen good correction as far as the IT sector is concerned, and this is actually getting linked to the global technology correction as well. There is a lot of talks about recession and the impact of that. I think what is known today is that surely the global economies are going to slow, but what is sort of unknown is that what beyond that. I would imagine that technology spends are likely to continue. Maybe there could be slower growth, but the growth itself will remain. Good part is that because of this correction, the valuations have become more palatable, is what I would say. The next 6 months, when the noise around the recession slowdown is high, and let's say the stocks tend to consolidate or weaken more, I think that probably should be a good opportunity to keep accumulating.
Right, and JP Morgan Chase CEO Jamie Dimon has actually warned of a recession in the United States in as early as the next 6 to 9 months. Speaking with CNBC, he highlighted that high inflation, big interest rate hikes, and the Russian invasion of Ukraine, along with Fed's policies, as potential indicators of an economic slowdown, an impending economic slowdown. That is, he added that the Federal Reserve waited too long to act, but is now catching up fast. Let's hear him out.
It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now. In hindsight, they waited too long and did too little, and QT should have started sooner and all that. But they're clearly catching up. They're clearly motivated to catch up, and from here, let's all wish them success and keep our fingers crossed that they manage to slow down the economy enough that it doesn't, to cause it, whatever it is mild.
All right, to the second headline now. TCS ended the day lower by 1%, despite reporting a healthy growth in their constant currency and better than expected margins in the second quarter. The reason perhaps could be attributed to the caution that the management sounded with regards to some of the tone in which the clients were speaking. But for numbers and more, we have Reema with us. Reema.
Well, thanks so much for that. So let me start with the basic numbers. So a beat on revenue, a beat on margins, and beat on profitability. So TCS's numbers surpassed expectations. The management commentary was fairly upbeat. So despite the macro situation being volatile, as of now, there has not been any business impact. The deal pipeline continues to remain fairly intact. They reiterated that Q4 FY23 margins will rise to 25%. They also said that attrition has peaked and therefore will start show signs of moderation in the second half of the year, and deal wins will be sustainable. So the deal win guidance of $7 to $9 billion stays intact, not just for this year, but even for the medium term. But what could be the potential weak spots in the earnings this time? Well, the margin gain, the margin improvement was courtesy currency. If you strip that out, the margin expansion is only 40 basis points. So that is something the analysts are talking about. Secondly, they're already talking about growth moderating in insurance and discretionary retail. When quizzed, when we quizzed the management about where else could we see pressure if the situation deteriorates, they said Europe manufacturing. They've already indicated that long-term decision-making in Europe is seeing signs of delay. hiring numbers have also spooked the street a bit because it's come in at a 9-quarter low, and it's very often seen as a lead indicator of future demand. So is the company hiring less because they anticipate growth to moderate? Well, that is something the street is worried about. And although attrition has peaked, it's still at very high, uncomfortable, elevated levels. The last 12-month attrition number is at 21.5. Back to you.
There is an increasing cautionary tone in our clients' discussions. That is not resulting in a project cancellation, or they're not saying that we are at panic stations. But there is that caution. I would say that as we look forward into the next 6 to 12 months or 18 months, we are going to go to a period of execution focus, of operational rigor, of not about news flow, but about actually getting the work done. And that, I believe, is TCS's sweet spot.
Fair enough.
And that's where we believe that, yes, we need to be vigilant. Yes, we need to be. But overall, I think that we are in a good place. We have a credibility with our customers, and their plans, we have not seen them pull back. They have stopped talking about it, but they're not pulling back because it needs to get executed. This time around, if the weakness starts, it's likely to come in from the manufacturing side as energy, supply chain disruptions start. So we need to be wary of that. Within that spectrum, we see US manufacturing doing very well. We see some amount of caution on the European manufacturing side, and that bears watching as to how that plays out. And we need to be careful about how we are positioning on that.
With that, we move on to the third headline today. This one also coming in from the IT pack. In fact, Infosys was the one which was lower by almost 3% after the IT major said that its board will consider a share buyback after the meet on Thursday itself. Analysts anticipate the offer to be at a significant premium to the market price. Rima is back with us to tell us about this buyback and the company's plans, as well as the past buybacks by Infosys.
Thanks so much for that. So Infosys will be considering a buyback along with its earnings on Thursday. IFL says the maximum buyback that the company can do will be 18,500 crore rupees. But they believe the buyback size will be close to 11,000 to 12,000 crore rupees. So this time, the buyback is likely to be higher than the buyback that we've seen in the last two instances. In the last two instances, that is in 2021 and 2019, the buyback size was 9,200 and 8,260. Why is it that the street is anticipating that the buyback size will be higher this time? Well, the reason is they need to meet their stated capital allocation policy. The stated capital allocation policy of Infi is that they will return 85% of their free cash flow over FY20 to FY24. Up until now, till FY22, the company's only returned 73%, which means it needs to play that catch-up, which is why the street expectation is that this time the buyback could be higher, maybe 11 to 12,000 crore rupees, as IFL pointed out. Remember, they have ample cash in their books, close to about $4.5 billion. So cash is not going to be a problem. So buyback size could be higher. Now, typically, the past buybacks tell us that it takes place at a premium, sometimes 15, sometimes 18. IFL says, according to them, the maximum expected buyback price should be 1,800 rupees per share, which is roughly a 15% premium to where the current market price is. And it could be an open market buyback like the last two. Back to you.
All right, Rima, thanks a lot for that. With that, we'll step into a short break, come back. On the other side, we'll get you more headlines that we're tracking today. Welcome back. You're still here with us on Markets Today. We spoke about the decline in IT stocks despite good numbers coming in from TCS and the buyback announcement from Infosys, and the way the markets fell on account of weakness in the global headlines. But let's talk about all the other headlines that we're tracking for you today. And this one is from the cement pack. India Cements was one of the stock which, one of the stocks which tanked about 11% after the company inked a deal with JSW Cement to acquire its subsidiary with limestone reserves, Spring May Mining. The stock fell due to its price valuation and lack of visibility for capex going further. Nigel D'Souza joins in with more details on this deal.
Well, JSW Cement has gone ahead and bought India Cement's subsidiary, that's Springware Mining Private Limited. The key asset in this particular subsidiary is a limestone mine that they have in Madhya Pradesh. The total quantum that they mentioned is around 477 crore rupees. Motilal Oswal in their note, they mentioned that they've had a conversation with the management and they expect another 127 crore rupees, which effectively was the money that was given by India Cements to this particular subsidiary, including interest. So the total deal value, they say, is around 604 crore rupees. The impact of this is they could effectively reduce that by close to 20% because the last reported debt number was around 3,100 crores. The promoter intent as well will be read positively. And what the street will wait for is any kind of clarity whether or not they want to sell any of their other assets. Maybe the Rajasthan asset that they have, which is around 1.5 million tons. Well, it's a step in the right direction, but brokerages, they're not very enthused. Motilal says they reiterate their sell rating, though they've increased the target price to around 180 rupees. Valuations is one factor that they cite. It's trading at close to around 15 times EV upon EBITDA and also $82 on an EV per ton basis. They're saying there's no big capacity addition that they're talking about on the net debt to EBITDA basis as well. Things look elevated. Moving to Nuvoma, they say the move is certainly welcome, but more needs to be done on the deleveraging front. And if there are higher sales of non-core assets, then they'll be impressed. They maintain reduced with the target price at around 112 rupees from around 103 rupees earlier.
All right, Nigel, thanks a lot for that. With that, we move on to the fifth headline of the day. A bunch of stocks in focus. Divi's Labs, the top nifty loser after it fell over 5%. Export trends for the second quarter indicated that the company may see over a 20% revenue decline on a quarterly basis, according to IIFL Institutional Equities. Vivek Iyer joins in with the details on that itself. Vivek, fell and ended at the low point of trade.
That's right. So Divi's Labs today is one of the losers. A very interesting note has come in from IIFL Institutional Equities, where the analyst has actually gone ahead and tracked the second quarter FY23 export data trends. So in this particular data, that point that he's actually pointed out, they are saying that they may see a greater than 20% sequential revenue decline as far as Divi's Lab is concerned for Q2 FY23. So what they're saying is that this basically indicates that the company may see a dip in revenue both in Molnupiravir, which was a one-time impact or a one-time boost that the company got in terms of revenues. That particular drug was used for the treatment of COVID. But more worryingly, it also indicates that there has been a dip as far as the base business, that is the core API business, is concerned, and which is why this particular stock, on the back of such a steep decline, is seeing a fall. Now, what is more interesting is that in some of the preview notes that we had a look at, most of the analysts have actually penciled in a 0 to 8%. In fact, BofA Securities is right in the middle, around 2% revenue decline is what they are looking at sequentially. So if you see a much larger than expected revenue decline, one of the reasons why Divi's Labs is falling today is this particular development.
All right, the other bunch of stocks that we are talking about, we had Automotive Axles ending in the green after Cummins Inc. Made an open offer to acquire 26% stake in the company. Though along with the market, the stock ended closer to the low point of trade. It outperformed by ending marginally higher. Sonia joins in with the details on that deal as well.
Thanks a lot for that. So this is an interesting one. Cummins, in any case, had to make a mandatory open offer for Automotive Axles because they hold about 35.5% stake. But Automotive Axles is now up almost about 4% odd. The open offer by Cummins is for the acquisition of around 40 lakh shares of Automotive Axles, representing 26% of the share capital. Now, BF Investments is the other promoter in the company. So Automotive Axles is currently co-promoted by the Kalyani Group's BF Investments as well as Meritor Inc. Now, once Cummins open offer goes through, it will be co-promoted or co-owned by BF Investments as well as the Cummins Group. Now, the stake that BF Investments holds is 35.5%, which means it's worth 1,137 crores at the current market price. The big question is, will the Kalyani Group tender into the open offer? They may not, because the open offer price at 1,500 is much lower than the current market price for Automotive Axles. But the company has done very well in the recent past. If you pull up the chart of Automotive Axles, it's more than doubled since Jan of 2021. It is a 41-year-old company. It manufactures axles, brakes, suspension systems for the trucks and buses segment in the commercial vehicle industry. And if you look at the past performance, the numbers have looked pretty good. So, in Q1, the revenues, for example, went up 96% year-on-year at 500 crores. The profits also went up quite a bit. Of course, the base was low. But if you map the last 6 quarters of Automotive Axles, it had 3 really subdued quarters. The revenues, the average revenues have gone up in the last 2 quarters. So business is definitely picking up. Hence, an interesting move over there.
An interesting mover there, but the other stock which was in focus was Sobha, down 4% after its second quarter business update. Vahista joins in with the details on that. Vahista, weakness in the second quarter?
Well, Sobha Limited has released its real estate operational update for Q2 of FY23, wherein the total sales value was up 13% year-on-year, and the average price realization was up 14% year-on-year to approximately 8,700 rupees per square foot. However, on a quarter-on-quarter basis, that is sequential basis, there is not much growth, with total sales value which was marginally up 2%, and the average price realization was up just about 3%. Now, on a half-yearly basis, though, the numbers look good, with the total sales value up 35% year-on-year, while the average price realization was up 12% year-on-year. Now, the new sales in terms of square foot was higher in cities like Bangalore and Coimbatore in Q2 of FY23, but was lower in Kerala, in Gurugram, in the GIFT City, Chennai, and in Pune. There was also 3 new residential projects which were launched in Q2 of FY23, 2 of which were in Bangalore and 1 was in Trivandrum. And this refers to a total saleable area of 8.8 lakh square feet. Back to you.
Take that point, Vahista, but stay with us. We have Panacea Biotech as well, which rallied about 18%. It received an order worth over 1,000 crore rupees. Take us through those details.
Well, the company has received a long-term supply awards, which is worth approximately $127 million, which is nearly 1,000 crore rupees. This is a contract from UNICEF and Pan American Health Organization for the supply of its WHO pre-qualified fully liquid pentavalent vaccine. And the UNICEF award is worth approximately $100 million US dollars. This is for the supply of approximately 100 million doses during the calendar year 2023 all the way up to 2027. And Pan American Health Organization award is approximately 30 million US dollars for the supply of 25 million doses from 2023 to 2025.
All right, Vahista, thanks a lot for that. With that, it's a wrap on this edition of Markets Today. Thank you so much for watching. Stay tuned to CNBC-TV18.
Brought to you by